Hello everyone. I fully exited positions in Nvidia, Amazon, ASML, Micron, onsemi, and even Alphabet. Now I have been lucky to buy those companies early. I literally have put all my life savings in Nvidia in January 2024, and I have been adding aggressively on every major dip, such as DeepSeek dip on Liberation Day and that unexplainable ASML dip in July 2025 when the stock price went down to 700 for no apparent reason. On each dip, I have increased my leverage through margin depth since returns were so fast to come and have outgrown margin interest by a wide margin. I kept buying and holding through volatility. This recent rally got me worried because as risks on multiple fronts have gone up, both in scale and predictability, the prices have gone up too, increasing the disconnect between the stock price and the business behind them. I still think that those are wonderful companies with a bright future ahead of them, but ultimately, I'm in the business of building wealth. So, as a measure of proactive risk management, I have rotated capital into energy, infrastructure, and base materials, where I can see a better risk to reward setup. That being said, I still hold two companies in physical AI theme because I believe that physical AI is the next big wave of this technology, and unlike LLMs, physical AI have more predictable return on investments, and the peak prices for physical AI won't be reached for another few years, if not more. The mainstream financial media has covered the obvious effects of war in Iran, such as rising cost of crude oil and immediate energy costs. So let's look at other critical elements of supply chain that were disrupted. The big one is helium. One third of world production of helium was located in Qatar, which is now trapped and is unavailable for the global market. And maybe more importantly, the production is not just trapped, it was also damaged. Analysts say that Qatar's LNG capacity could be disrupted for up to 5 years. And helium is a byproduct of LNG production. Taiwan Semiconductors hold 3 to 6 months of helium inventory, but South Korean chip manufacturers that source approximately two-thirds of their helium from Qatar are more exposed. Also, analysts warn that if the shortage persists beyond 6 months, production delays across global electronics supply chains could follow. The other critical gas that is experiencing supply chain problems is bromine. Bromine's role in semiconductor manufacturing is specific and non-substitutable, and Israel with Jordan together account for roughly two-thirds of bromine supply. Jordan outages, Israeli output cuts, and Hormuz disruption continue to tighten global supply. What makes this problem even more severe? Some of the other biggest bromine production lack semiconductor-grade hydrogen bromide gas conversion capacity. Building such capacity would take years. Article could be summed up in one last sentence. The global memory supply chain has built itself around a conversion choke point with no redundancy and no fallback. If ACL's Sodom facility goes offline, the gap does not get filled. And the problem of this disruption is that it can happen any day because we have seen that the Iranian side have deliberately targeted manufacturing facilities and using economic damage as their leverage in waging this war against United States. The second major bottleneck is the physical grid. Half of planned US data centers builds have been delayed or cancelled, growth limited by shortages of power infrastructure and parts from China. Because of the trade war between the US and China, the data center buildout is experiencing shortage of power delivery equipment, and it is causing a slowdown in project timelines. Electrical infrastructure represents less than 10% of total data centers cost, but it is as vital as compute hardware. A delay in any single element of the power chain can halt the entire project, which makes transformers, switchgear, and similar devices critical items, despite their relatively small share of capex. To mitigate that risk, US data centers are going off grid, ordering and building their own energy capacity, and a big winner from that would be a company like Caterpillar, who generated 10 billion in data center generator sales and have a record backlog surging to 63 billions. But still, energy crisis persists, especially severe in US and Western Europe, So, one of the obvious places where I rotate my capital is energy sector. Another supply chain shortage is in germanium and gallium, rare earth metals. And for those who don't know, germanium and gallium are used for optics, and modern AI focused data centers require approximately 36 times more fiber than traditional CPU based racks. And China has leveraged their dominance in production of rare earth by export controls. The latest customs data from Beijing shows that exports for both critical materials collapsed in April, with gallium shipments reduced to just 3 kilograms and germanium shipments reduced to virtually zero. The figure marks a collapse of more than 99% compared to the previous months. After recent US China talks, there was no clear breakthrough on rare earth, and Beijing's fundamental stance restricting exports when they may pose risk to national security under so called dual use considerations appears unchanged. Now, even if we looked past specialized elements, the fundamental infrastructure requires massive volumes of base metals like copper and aluminum for power transmission and thermal management. Both metals face structural deficits due to underinvestment in global mining capacity over the last decade. Copper is abundant in the ground, but there is not enough being extracted to be able to meet the demand. That's because investors want higher and more reliable returns than copper mines currently offer, and the industry faces complex permitting processes and simply can't find enough workers. Some analysts predict that the copper deficit could reach 30% of total demand by 2035. Lead times for new copper projects alone around 17 years from discovery to production, and many major projects have recently experienced significant delays and cost overruns. Also, there is an interesting paradox. Despite record copper prices, smelter fees have fallen to record lows, underscoring deepening risk for the midstream sector. And guess which country could be the reason for that? You guessed it right, it's China. These dynamics have been driven by a surge in smelter capacity additions from China. As a result, competition among smelters for concentrate has ramped up, sharply weighing on smelter fees. In 2025, China controlled 50% of copper smelter production, adding another layer of economic leverage China has over the AI trade. Aluminum market facing serious and prolonged supply outage. The Iran war and Strait of Hormuz disruption have triggered a historic aluminum supply crisis, damaging major Gulf smelters and cutting Western production by 2.4 million tons in just 2 months. Two Gulf aluminum smelters were damaged in missile strikes, and those were the largest production plants outside of China. Again, it's not just the rise in cost of aluminum, but the physical shortage that can cause the slowdown in growth. Going back to April and May rally, we need to understand that it was mainly based on two factors: geopolitical optimism and corporate financial reporting. Risk-on sentiment surged following the news of ceasefire between the US and Iran that was aimed at reopening the Strait of Hormuz, and the mere prospect of de-escalation caused a brief 10% drop in crude oil prices. Second, Q1 2026 corporate earnings came in exceptionally strong. Aggregate year-over-year earnings growth tracked near 29%, significantly outperforming initial analyst consensus, estimated of roughly 16%. However, a closer look at the data suggests that the market is prematurely pricing a best-case scenario. Regarding the diplomacy, a permanent resolution is likely much further along than current equity multiple assume, and even if peace deal would be achieved in next 60 days, the effect on supply chain, insurances cost, and damage done on manufacturing will persist, as well as the risk of re-escalation of the conflict. More importantly, Q1 earnings are inherently backward-looking. They reflect pricing agreements and material costs that were locked before the war in Iran. Relying on Q1 margins to justify buying peak tech valuations assumes that the operational environment remains static, and the reality, evidently, is much different. As I said in the beginning, I haven't fully exited AI stocks. I still hold Intuitive Surgical and Sony. Both companies, I believe, are somewhat insulated from the current AI trend, and both companies have a long runway for growth, with catalyst events that could re-accelerate their growth further down the road in the next 3 to 5 years. About half of the freed capital was used to pay off my margin debt. The rest I have rotated into copper through Eurocopper, into energy buildout through Cadler and Total Energies, an uncorrelated biotech company, Halozyme Therapeutics, which I believe is significantly undervalued, and two emerging market fintechs, Mercado Libre and Amazon PayPal of Latin America, and Kaspi KZ, a super app from Kazakhstan, which is actively expanding into Turkey. I believe I covered most of the stocks on this channel earlier, so if you're interested, go have a look. And if you want to learn more about some of them, also do tell. Thank you for your time. Like and subscribe. Have a nice day.